When it comes to saving for the future, the tax code is more than a set of rules. It's a roadmap. It tells you how to save, how much to save, and when the government wants to take its share. In this episode, we're talking about retirement plans and tax-advantaged accounts. The plans designed to help individuals and businesses prepare for life after work. We'll start by dividing them into two broad categories: qualified and non-qualified plans. A qualified plan meets the requirements of the Employee Retirement Income Security Act of 1974, better known as ERISA. That means it offers tax-deferred growth, deductible contributions, and federal protection of participants' benefits. But there's a catch. These plans must be offered in a non-discriminatory way. In other words, they must benefit employees fairly, not just company executives or owners. A non-qualified plan, by contrast, doesn't meet ERISA requirements. It's not tax deductible for the employer until benefits are paid out, and it doesn't have to be offered to everyone. It's often used to reward key employees or executives with deferred compensation. Now, within the world of qualified plans, there are two main structures: defined benefit and defined contribution. A defined benefit plan promises a specific payout at retirement, often based on salary history and years of service. Think of it as the old-fashioned pension. The employer bears the investment risk and must ensure enough money is in the plan to meet the obligations. A defined contribution plan, on the other hand, specifies how much goes into the account, not what comes out. The benefit at retirement depends on investment performance. Here, the employee bears the investment risk. Examples include 401k, 403b, and profit-sharing plans. Let's take these one by one. A 401k plan is perhaps best known defined contribution plan. Employees can defer a portion of their salary into the plan on a pre-tax basis, and many employers will match part of those contributions. Money grows tax-deferred, and withdrawals are taxed as ordinary income. Withdraw before age 59.5, and you'll face a 10% penalty unless an exception applies, like death, disability, or separation from service after age 55. A 403b plan works almost the same way, but it's for employees of public schools and tax-exempt organizations. Contributions are made to tax-sheltered annuities, or TSAs. Then there are 457 plans used by state and local governments and certain nonprofits. They look similar to 401ks, but they're not subject to the same early withdrawal penalties. Another common structure is the profit-sharing plan. Here, contributions are discretionary. Employers decide each year whether to contribute and how much. Allocations are typically based on compensation levels, and contributions are capped by IRS limits. And in a similar spirit, there's the money purchase plan, which looks like a profit-sharing plan, but requires fixed annual contributions regardless of profits. For small business owners, there are a few special plans worth remembering. The Simplified Employee Pension, or SEEP IRA, allows an employer to make contributions directly into each employee's IRA. It's easy to administer and has higher contribution limits than a traditional IRA. The Simple IRA, that's Savings Incentive Match Plan for employees, is another option for small employers. It allows both employee salary deferrals and employer matches, but the limits are lower than a 401k. Both CP and Simple plans are funded with pre-tax dollars, grow tax deferred, and are taxed as ordinary income at withdrawal. Now let's talk about individual retirement accounts, or IRAs. A traditional IRA allows individuals with earned income to make tax-deductible contributions, subject to income limits if they're covered by an employer plan. Earnings grow tax-deferred, and distributions are taxed as ordinary income. Withdrawals before age 59.5 trigger that same 10% penalty, unless the funds are used for specific purposes, like first-time home purchases, higher education expenses, or certain medical costs. Required minimum distributions, or RMDs, begin at age 73 under current law. A Roth IRA, on the other hand, flips that arrangement. Contributions are made with after-tax dollars, no deduction up front, but both earnings and withdrawals can be tax-free, provided the account has been open for at least 5 years and the investor is at least 59.5 it. Roth IRAs also have no required minimum distributions, which makes them useful for estate planning. Contributions to both traditional and Roth IRAs are limited each year, with additional catch-up contributions allowed for those 50 and older. Now, for the Series 7, here are a few patterns you can count on seeing. Traditional IRA, deductible contributions, taxable withdrawals. Roth IRA, non-deductible contributions, tax-free withdrawals. Qualified plans must meet ERISA standards, offer tax-deductible contributions, and provide benefits fairly. Non-qualified plans, no immediate tax deduction, and benefits are taxable when paid. And always watch for the penalty triggers. Withdrawals before 59.5 or failing to take RMDs on time each carry a 10% penalty on top of normal taxation. In the bigger picture, retirement plans aren't just about tax deferral. They're about creating structure, a long-term incentive to save, backed by regulation and discipline. And that's what the exam will test. Not just the tax math, but the logic of why each plan exists. If there's one thing to remember, it's this. The earlier you start saving, the more time you give compounding to do its quiet, powerful work, and the more valuable these plans become. Next time, we'll move into Chapter 12, Options, Strategy Spreads and Straddles, where risk becomes strategy and precision meets possibility.